The meeting that left no minutes. In 1910, the blueprint for the modern monetary system was drafted during a private meeting whose participants traveled under false names and left behind no official transcript. Yet the financial rules created there still determine how money enters your economy today. The mechanism was built by leading bankers and policymakers attempting to prevent future banking collapses after decades of instability, threatened industrial expansion, and concentrated wealth alike. What you have been paying for ever since is not simply inflation or interest, but the cost of a monetary system engineered to manage crises before the public even understands one has begun. The question rarely asked is simple and uncomfortable. Who writes the rules of money when panic makes transparency feel too dangerous to allow? At the start of the 20th century, the United Banks operated independently, currency supply fluctuated unpredictably, and seasonal credit shortages repeatedly pushed the economy toward collapse. Farmers could not access liquidity during harvest cycles. Businesses faced sudden credit contractions unrelated to productivity. Markets did not fail slowly, they froze without warning. Each panic exposed the same structural weakness. Money itself lacked coordination. Financial elites understood something the public did not yet see. Economic growth had outpaced the architecture designed to support it. Railroads, steel, and global trade required stable credit flows, yet the nation relied on fragmented banking reserves scattered across thousands of institutions. Stability depended less on law than on confidence, and confidence disappeared quickly. The absence of a central authority meant crises were solved improvisationally, often by private financiers acting in moments of emergency. That improvisation would soon reveal a deeper vulnerability, one that turned a financial panic into the justification for redesigning money itself. America before central banking. Before a central bank existed, the American financial system operated on a paradox. The fastest-growing industrial economy in the world depended on one of the least coordinated monetary structures among major powers. Money was not centrally issued according to national demand, but tied to bank reserves, government bonds, and regional conditions that rarely aligned with economic reality. Currency shortages appeared not because wealth disappeared, but because the system could not move liquidity where it was needed fast enough. In autumn months, cash drained from financial centers into agricultural regions to finance harvests. Banks in cities suddenly faced reserve pressure, forcing them to restrict lending precisely when businesses required credit to sustain expansion. Interest rates surged unpredictably. Sound companies failed alongside weak ones. Economic survival often depended less on productivity than on geographic access to cash. The system rewarded proximity to financial hubs rather than efficiency or innovation. European powers had already adopted central banking models capable of redistributing liquidity during stress. American policymakers resisted such concentration of authority, fearing centralized financial power after earlier battles over national banks in the 19th century. Yet resistance created an unintended outcome. Private financiers became unofficial coordinators during crises, exercising enormous influence without formal responsibility. Every panic reinforced a quiet realization among industrial leaders and lawmakers alike. A nation unwilling to centralize monetary authority publicly was already relying on private coordination behind the scenes. The contradiction remained unresolved until one crisis exposed just how fragile the arrangement truly was. The panic that changed incentives. In October 1907, the American financial system came within days of total paralysis, not because the country lacked wealth, but because trust between banks collapsed faster than money could move. Depositors rushed to withdraw funds, credit markets froze, and institutions that appeared solvent in the morning faced failure by nightfall. The crisis revealed a dangerous truth. Modern economies could implode without a mechanism capable of supplying emergency liquidity at scale. With no central bank to intervene, responsibility fell to private financier J.P. Morgan, who gathered banking leaders inside his library and personally coordinated rescue efforts. He assessed balance sheets, organized capital injections, and decided which institutions would survive. Markets stabilized not through public authority, but through the judgment of one individual whose private resources temporarily replaced a missing national system. The episode altered incentives for everyone involved. Politicians recognized that relying on private figures to save the economy exposed the government's institutional weakness. Bankers understood that repeated crises threatened long-term profitability and public legitimacy. Industrial leaders saw that expansion required predictable credit conditions impossible under panic-driven improvisation. Most importantly, the public witnessed stabilization without fully understanding how it occurred. The rescue appeared almost mysterious, masking the structural lesson unfolding beneath it. Financial stability required permanent coordination, not heroic intervention. Within policy circles, the question shifted from whether reform was necessary to who would design it. That question would soon be answered far from public scrutiny, in a location chosen precisely to avoid attention. The Island Gathering. In November 1910, a small group of financiers and policymakers quietly departed from a New Jersey train station under conditions designed to avoid recognition, traveling south in a private railcar with instructions to use first names only. Their destination was Jekyll Island Club, an exclusive retreat owned by some of the wealthiest families in America. No press announcements were made. No official agenda was published. The purpose was not secrecy for intrigue, but insulation from market reaction while designing structural reform. Among the participants were Senator Nelson W. Aldrich, Treasury official A. Piat Andrew, and banking figures including Paul Warburg, whose experience with European central banks shaped much of the discussion. Their shared objective was to construct a system capable of preventing another 1907-style collapse, while remaining politically acceptable to a nation deeply suspicious of centralized financial power. The challenge was architectural as much as economic. A visible central bank risked public backlash, yet decentralized banking had proven unstable. The solution required institutional design that appeared regional and balanced while functioning as a coordinated national authority. Over several days, the group drafted a framework for reserve pooling, emergency lending, and currency elasticity, translating crisis lessons into technical structure. What emerged from the island was not legislation, but a blueprint, carefully engineered to later pass through democratic institutions without revealing the concentrated authorship behind it. The next challenge was transforming a private design into public law without exposing how deeply the system had already been decided. Designing elastic money. The central innovation drafted after the island meeting was the concept of an elastic currency, a form of money designed to expand and contract according to financial conditions rather than remain fixed to physical reserves. Until that moment, currency supply was constrained by gold holdings and government bond issuance, meaning liquidity could not respond quickly when panic spread through markets. Crises intensified not because economies lacked value, but because money itself could not adapt to sudden demand for cash. The architects of reform understood that stability required flexibility. By allowing banks to convert qualified assets into newly issued currency during stress, the proposed system would transform money from a static object into a managed instrument. Credit could be supported during downturns, preventing bank runs from cascading into nationwide collapse. The public would experience fewer visible panics, while the mechanisms controlling supply operated largely beyond everyday awareness. This change altered the relationship between time and finance. Previously, economic expansion was limited by the slow accumulation of reserves. Under an elastic system, monetary authorities could accelerate or restrain credit cycles through policy decisions rather than physical scarcity. Stability no longer depended solely on market discipline, but on institutional judgment. Yet elasticity introduced a new dependency. If money could expand when necessary, someone had to decide when necessity existed. Authority shifted from metal-backed certainty toward human governance, raising a question rarely discussed openly. Who determines the correct amount of money for an entire economy? And by what incentives are those decisions guided? The answer would emerge only when the proposal entered the political arena. From proposal to law, transforming a privately drafted monetary framework into national legislation required more than economic logic. It required political translation. After the Jekyll Island discussions, Senator Nelson W. Aldrich introduced an initial reform proposal shaped by the group's blueprint, but public reaction exposed a critical obstacle. Americans distrusted concentrated financial power, and any system perceived as controlled by Wall Street risked immediate rejection. The mechanism therefore evolved through deliberate rebranding rather than structural abandonment. Reform advocates reframed centralization as decentralization. Instead of one dominant national bank, the emerging design proposed multiple regional reserve institutions, giving the appearance of distributed authority while maintaining coordinated control. Banking reform was presented as protection for ordinary commerce and agriculture, rather than stabilization for financial elites. Language shifted carefully. The system would not be called a central bank. It would be described as a reserve network serving the public interest. Political turnover unexpectedly aided the transition. With the election of Woodrow Wilson, reform gained new momentum under Democratic leadership willing to reshape the proposal while preserving its core mechanisms. Congressional debates focused on governance details, masking how much of the technical structure had already been settled years earlier. By the time the Federal Reserve Act passed in 1913, the public saw legislation born from democratic process, not the culmination of a pre-designed architecture. The law appeared new, yet its operational logic was already mature. What remained unclear was how this institution would maintain both independence and legitimacy once it began exercising power over the nation's money supply. The architecture of distance. When the Federal Reserve System began operations in 1914, its most important feature was not monetary policy, but structure. Authority was intentionally divided between a central governing board in Washington and 12 regional reserve banks spread across the country. This arrangement created institutional distance between decision-making and direct political pressure, allowing monetary control to function continuously even as governments changed. Power existed, but it was layered, technical, and difficult to map from the outside. Regional banks were owned by member commercial banks, while oversight rested with federally appointed governors. Public and private elements were blended into a hybrid institution that did not fit traditional categories. This ambiguity was deliberate. Complete government control risked short-term political manipulation of money, while full private ownership threatened legitimacy. The system's designers attempted to solve both problems simultaneously by dispersing visible authority while coordinating operational outcomes. Complexity became a stabilizing mechanism. Policy decisions emerged from committees, reports, and technical procedures inaccessible to most citizens. Monetary governance shifted into a professional domain dominated by economists, bankers, and analysts whose language separated financial management from everyday political debate. The public experienced outcomes, such as interest rates and credit conditions, without directly observing how those outcomes were produced. Over time, distance itself generated trust. Markets assumed continuity because decisions appeared insulated from immediate emotion or electoral cycles. Yet this same distance created a new condition, a monetary system essential to daily life that few participants fully understood. The true test of this architecture would arrive when crisis returned and the institution faced pressure to prove its purpose. Crisis as proof of design. The legitimacy of the new monetary system was not established through theory, but through crisis. Only a few years after its creation, the Federal Reserve faced the financial disruptions surrounding World War I, followed by the volatile credit expansions of the 1920s and the devastating collapse of the Great Depression. Each emergency forced the institution to act, transforming abstract design into visible intervention. Stability became measurable not by the absence of downturns, but by the system's capacity to respond when markets failed. During earlier eras, banking panics triggered uncontrolled cascades of failures because no authority possessed both information and liquidity at national scale. Under the new framework, reserve banks could extend credit, purchase assets, and influence lending conditions across regions simultaneously. The system demonstrated that monetary crises could be managed through coordinated policy rather than improvised rescues led by private financiers. Yet success carried a subtle consequence. Every intervention reinforced the perception that economic stability depended on centralized monetary action. Markets began anticipating support during stress, altering risk behavior across financial institutions. The safety mechanism gradually became an expected feature of the system rather than an emergency exception. Monetary authority expanded not through explicit power grabs, but through repeated reliance during instability. Public understanding, however, lagged behind institutional evolution. Citizens experienced recoveries and recessions without seeing how policy decisions shaped both outcomes. The Federal Reserve proved its necessity in moments of danger, but the deeper origin of its authority faded from collective memory, setting the stage for a modern economy operating on mechanisms few could trace back to their creation. Modern money without memory. Today, most economic participants interact with money as if it were a natural feature of society rather than a designed system shaped by specific historical decisions. Salaries arrive digitally, loans expand purchasing power instantly, and interest rates shift entire industries without visible legislative debate. The mechanisms created in the early 20th century operate continuously, yet their origins remain largely absent from financial education. The system functions best when its architecture feels ordinary. Modern currency is no longer primarily physical cash, but bank-created credit, regulated through central bank policy. When lending expands, money supply grows. When policy tightens, liquidity contracts. These adjustments influence employment, housing markets, and investment cycles long before individuals recognize the cause. Economic outcomes appear personal or market-driven, even when they originate from institutional calibration developed decades earlier. Historical memory faded gradually because stability reduced urgency. Unlike earlier generations that experienced frequent bank runs, modern citizens rarely witness systemic collapse directly. The absence of visible panic removed the need to understand monetary plumbing. Financial awareness shifted toward personal budgeting and investing, while structural knowledge of money creation receded into specialist domains. This separation produced a paradox. People live entirely inside a managed monetary environment, while perceiving money as neutral or self-regulating. The design succeeded so completely that its construction story became irrelevant to daily conversation. Yet ignoring origins carries consequences, because every new reform builds upon foundations laid long ago, and those foundations determine which solutions become possible when the next transformation arrives. The principle hidden in plain sight. The most enduring lesson of the meeting that shaped modern money is not secrecy, but timing. Monetary systems are rarely redesigned during periods of stability. They change when crisis compresses decision-making into narrow windows where technical expertise moves faster than public understanding. The architects of the early 20th century reforms did not wait for consensus. They prepared solutions before panic forced adoption. When instability arrived, readiness became authority. History shows a consistent pattern. Financial structures emerge from moments when existing systems fail visibly enough to justify transformation, yet urgently enough that detailed public debate becomes secondary to restoring confidence. Those capable of organizing workable frameworks during uncertainty shape the rules that follow long after the crisis fades. Legitimacy is then built retroactively through law, performance, and institutional continuity. The Federal Reserve's creation illustrates how economic power often resides not in ownership of money, but in designing the mechanisms through which money responds to stress. Control operates through structure rather than proclamation. Once established, these structures persist because replacing them would require another moment of comparable instability. The applicable principle is clear and historically grounded. When financial crises dominate headlines, attention should move beyond immediate losses toward institutional proposals presented as necessary solutions. The future rules of money are usually written at the moment when fear makes structural change acceptable. Understanding this pattern does not predict the next reform, but it allows recognition of when monetary history is being written again. If this investigation changed how you see money, understand what that means. Financial power rarely hides information. It simply assumes most people will never look for it. This channel exists to document the mechanisms that shape your economic reality long before they appear in headlines or textbooks. Subscribe if you want to understand the systems while they are still operating, not after they have already rewritten the rules again. Hidden finance is not about predictions. It is about recognition.